Sorry, so we had a technical difficulty and we were not recording our first part of the negotiation, but we've only gone a little bit in, so we're going to start from there. It's basically been introductions.
Okay, so let's assume, I mean, quite frankly, bank policy would dictate that your company provides some upfront capital for your venture. But for the sake of moving this along, at this point, we're prepared to offer $4 million to secure the loan, which would mean you guys supplemented with 25% of your own capital into the venture. However, assuming we go with a $5 million number for the sake of moving this along, let's talk about what other terms could be negotiable. I mean, the $4 million is definitely something that bank policy would dictate, so there's going to have to be some extraordinary areas of wiggle room in other places if we're going to be able to secure a $5 million loan.
Absolutely. I understand that $5 million is not an insignificant sum of money, and especially for a new business venture in an emerging market.
So as far as the other terms are concerned, most of them are standard conditions that we apply in the loan. So for instance, the interest rate of 8.25% is the standard SBA 7A loan interest rate.
And how is that?
So that's how we start.
Oh, I'm sorry. How is that SBA interest rate calculated? Do you have any?
It's the standard maximum rate that the government sets out. So they set out basically banks only have authority to charge up to a certain amount of interest rate. And in part we can come down from there depending on your financial projections and your credit score and what kind of securities you can back.
Absolutely. And is the U.S. prime rate part of that SBA rate, or are they independent features? Yeah,
so essentially the 3% is as low as we ever offer to our most financially secure customers. This rate is calculated based on the amount of the loan and the length. So the SBA has, if you look at the chart online, it outlines for you. So less than 7 years at over 50K, I think is 7.75 is the maximum interest rate, and that's usually the standard place that banks start. And for a loan of 7 years or greater, the standard interest rate is 8.25%. So essentially, they sort of regulate the amount that banks can charge an interest depending on the length of the loan. It goes up the longer the length of the loan is.
And so that 8.25 kind of represents the maximum that the bank is able to charge for the loan.
Correct.
If I'm understanding correctly.
Correct. And so typically banks start at the 8.25% and come down from there depending on the quality of the credit of the applicant and the security interests that they can provide.
And then just so we're working from the same presumptions or same set of facts here. In my kind of preliminary research, and you're definitely the banker, so you tell me if I'm wrong, the U.S. prime rate that I looked up kind of for the current term right now is 2.25 to 2.5%. Is that a shared assumption?
Our bank operates off of a 3% prime rate. I don't have facts that indicate otherwise, at least. So 3% is definitely the lowest we can go.
Okay.
So I guess my question for you, given that you guys are a new company, why do you feel you should qualify for the prime rate, which is reserved only for our very best investments and very best creditors?
I think just because we do have we're on the cusp of this emerging market, and we do have a large parent company that does have some assets or liens against which we can secure the loan. But I would just like to go back to the rate a little bit. My understanding, though, the 2.25 is the prime rate, and then generally
I don't have authorization to go below 3%.
Okay. Okay.
It's the Citibank policy. My hands are tied. As much as I want this to move forward, I can't. The 3% prime rate is, at least from our perspective, is the bank's policy and is the maximum amount I could go.
And I understand where your hands are tied, and I'm perhaps not articulating myself quite correctly, but that is it. My understanding, and I may be flawed here because I'm not clearly not a financial whiz, that the prime rate is generally, the 3% is generally added to the prime rate, making what would be the best rate something in the 5.25% area.
Right.
I'm not advocating for the prime rate. Or
I got you. Okay.
An interest-free loan.
Yes,
so
yeah.
I just want to work from the same parameters here and kind of set. We're here to talk about numbers, and that's a difficult thing, but just so we're working with the same facts. I'm not trying to get you to go below prime rate or
that's right.
Just so we have kind of a zone to work from.
Sure.
As we kind of hash out these other terms. And so I'm sorry to belabor that. I just want to make sure we're working with shared assumptions or shared facts. And I know the bank's in the business of making money. As far as the 7-year loan term goes, is that also just kind of boilerplate standard loan terms?
Typically, yes. So that was based on our assumption that you would need a period of time, right? So you're expecting to break ground this year, and you begin distribution sometime next year. So it was sort of our estimation on how long it would take you to successfully repay the loan and have an opportunity to. There's a lot of upfront capital, right? So you have to have some period of time to go by before you can repay the loan. But you tell me what an appropriate loan amount looks like for you.
We would kind of like to push it in the 15-year range, just because we anticipate the construction costs and not or the construction time, and there's always inevitable delays, and kind of get our footing in the market so that we'd rather agree to loan terms that we can satisfy and pay back successfully than kind of ambitious terms that might kind of straddle the company and restrain our ability to grow and pay back the loan effectively. And so we would like a longer term than the 7 years.
Sure. It's $15 million a year, though. I'm trying to understand how, and you're anticipating some growth in your business. I'm trying to understand how you couldn't repay the loan within a period of less than 10 years.
That 15 million number, I believe, represents gross sales. So that's just the total volume that's sold. And of course, because we're talking about lentils here, the profit margin isn't huge. So you have to have a larger sales base on return. So we're not turning that, a pound of lentils isn't the same as a pound of gold.
But I suppose you don't know what the profit margin is.
I do not know what the profit margin is exactly, but I know we work in large volumes.
It's really hard to negotiate without some of these key facts. Okay.
So like I said, it's difficult to it would be difficult for us to pay the loan back.
So these are the only terms that you take issue with, is that right?
We are, of course, amenable to the providing financial records for the loan. The indemnification, we would have to talk about a little bit more.
Indemnification for environmental liability is pretty standard because the bank, although we are helping you secure the loan, we have no ability to mitigate any sort of environmental damages. we don't have any. We're not your agent. Just because we gave you a loan, so we don't have any sort of control over your day-to-day operations, and we can't risk putting the entire bank in jeopardy over a loan.
That does make sense and is reasonable now that you state it that way. I guess maybe we should, talk about how Pulse plans to secure the loan, or what kind of requirements the bank is looking for there. And I may be missing it. I don't see it on your... Thank you. I don't think we can agree to all of those things. I think that just the lien on the equipment should satisfy the loan amount.
So we're not especially interested. We would definitely need a lien on the equipment and the new facility, as well as at least one of the others. The problem with the equipment and the new facility is that it's not an easily liquidated asset, and it's really subject to market movement. So, and for instance, your equipment is going to be degraded over a period of time as you use it, as is the facility. So we don't really have a guarantee that we'll be able to use or liquidate, as well as, because we're not your agent, we don't have the ability to mitigate any damages that you do. So the security of the loan isn't necessarily fully backed by just the equipment. So I think we need at least one of the other two additional securities. Preferably because of Dalco Development's Dalco Agriculture's really good financial standing. We prefer if they can granted a guarantee. Is the parent company, is that something they're willing to do?
I think preferably for Dalco, because it's a separate business entity and it's emerging, we would rather, understanding the depreciation of the assets, rather secure it against security interest in Dalco Development, our shares of Dalco as a company. And that, I think, assuages some of those fears of the...
Certainly, because it's a more easily
it's a more liquid asset compared to the machinery. And so that way, if something were to go awry, there could be a fast influx of liquidity to satisfy some of that, and then also kind of those hard assets still.
And the lien. Okay, yeah, I think that that's we're probably amenable to that.
And then, if with those assurances of the shares and the equipment, we would, going back kind of to the underlying issue here, the loan amount, we would again ask for $5 million. And a term of 15 years.
Have you been in negotiations with any other banks? Do you have any? Do you have any other offers on the table?
As the nature of kind of securing loans, there's always you always shop around and see what the best deal you can get is. So
what? And do you have a sense of what other banks have offered you in terms of an interest rate, or any of the terms really?
I'm not really at liberty to discuss our discussions with other banks. While I see how that could be beneficial to kind of what your bank chooses to do, that's kind of outside the scope of what I think our conversation is here today. And I think, we're working from some shared assumptions as far as the interest rate goes, being set from I believe you said, from the prime interest rate, and kind of what your bank generally does.
Sure. So we could, I think that there's probably some wiggle room in the percentage of the interest rate if the loan could be further secured by Dalco Agriculture. Our concern, I think, is that you're a brand new company, and without the security, Dalco Agriculture is the company that has all of the assets, and they're the ones that have the good credit. You are brand new as far as we're concerned, and so you're sort of a baby lender in the eyes of the bank.
Mm-hmm. I suppose, just circling back, I guess, is fundamentally, if we can't kind of discuss that a baseline of the $5 million, then there's really, then my client's unable to move forward kind of without that basic assumption.
Sure, I understand.
Basic thing. So we could talk about interest rates and how to satisfy that for the bank, but if we can't tentatively come to an understanding that without reaching $5 million, we really have to move on and don't want to waste your time.
It's certainly more than we were anticipating. And as I said, bank policy dictates typically that we have lenders put up some of their own capital. So assuming that we're willing to provide a $5 million loan, we really are going to have to discuss the interest rate in conjunction with that, and the loan term, frankly, because $5 million is more than we were prepared to offer.
That's fully understandable. I just want to make sure we're not wasting our time talking about interest rates and loan terms for a loan that I'm not going to be able to agree to on the part of my company. So if we can move forward with the understanding that,
yeah, assuming we're talking about a $5 million loan.
Yes.
So I'll ask again, is Dalco Agriculture capable of securing the loan agreement?
Dalco could potentially secure the loan agreement, but I think that's going back to what is term 6 on your on this proposed loan agreement. Dalco would prefer to do a lien against the equipment and security interest in the shares.
Sure. The reason they're related, if it's not making sense, is that Dalco Agriculture, your parent company, is the one with the really strong credit. So if your aim is to get close to the prime rate, a security from them would go a long way in helping you secure a better rate. However, it's not mandatory if you want to negotiate this in a vacuum with Dalco Agriculture being out of it. We're going to have to look at you as a separate entity and consider your interest rate based on that. Do you understand?
Absolutely.
Okay.
As far as the length, your proposed 7 years, and our proposed 15 years, once again, kind of apart there. Do understand that the bank's in the business of loaning money and making money back on a timely.
Certainly, right? We stand to make more. We were hoping to secure. We were hoping to secure the full principal amount with interest within a 10-year period. 7 years is our starting point, but 10 years is. So subject to an increase in interest, we could potentially justify a longer loan term, as you said. the bank's in the position of trying to make money, and the longer the loan term is, coupled with a higher interest rate, the better we stand to fare.
And a higher interest rate from this 8.5 or 8.25 you have listed, which I understood to be kind of the maximum interest rate.
It is, but that's based on. I mean, you've provided no financial information to us regarding. I mean, maybe by no fault of your own. I don't mean to be disrespectful, but we don't know what your credit score is. We don't have a sense of how much of the profits from your continuing agreement are going to go to you versus your parent company. We just don't have anything to base a lower interest rate off of.
And what interest rate with that longer term would be amendable to the bank?
I mean, the 8.25% is the standard starting place for 7A SBA loans for brand new small businesses. So, especially considering we have no backing from anywhere else, and we're talking about extending the loan term to 15 years and offering you more than we had originally intended, I don't know how much we can move down from that.
But the bank doesn't envision requesting a higher rate than 8.25%. Am I understanding correctly?
No.
If we were able to shorten the term of the loan, could we bring the interest rate down, or is this kind of a stable factor for the bank? As you said, I understand.
Sure. No. They're moving pieces. The interest rate, of course, is more based on your creditworthiness and the lack of financial information you provided and the lack of security from the parent company gives the bank some pause. We would probably come down as much as a percentage point if the loan term was shorter.
Absolutely.
It's just a longer period of time for us to be at risk, I guess, is why we have a standard 10-year period.
No, that standard 7-year or standard?
7 years, yeah.
Okay. Could we, if we were to make concessions kind of on both sides and go to closer to a 10-year time frame, that would give us time to build, kind of establish our market channels, and then pay back kind of on the 7-year. It's almost like a little 3-year delay for us to, where it gives us 3 more years to get settled. Sure. And, be able to successfully pay the loan back. Could we come down to a percentage point?
Yeah, I think that we're agreeable to that, yeah.
And just tentatively, just to make sure a lot of moving pieces, like you said, and everything is in flux. So just tentatively, it looks like we're at a $5 million loan over a 10-year repayment period at 7.25 interest, and with the security that we discussed before, a security on the shares and a security on the equipment, or a security interest. A lien, was the...
That's right. So essentially we would cross out 6A. And then we also agreed to the environmental indemnification, the financial records, and the written approval prior to Dalco Ltd. Entering into any other future credit obligations.
And with that kind of prior written authorization to seek any other financial commitments, could we would rather prefer to work with one bank instead of borrowing from one bank to pay another bank.
Of course.
Is there some way that upon that we could we'd like to have a continuing relationship with this bank and not be going to other banks? So if there were other financing issues that we were to come up where we're needing more money, could we have a commitment from the? I mean, it's hard to give a commitment, but an understanding with the bank at least that we would come to them first, and there might be room for growth upon or for increased loans upon successful, timely payment of the terms. Say we were to need more money, and instead of having written permission to go elsewhere, if we were to come to the bank first after having displayed a good repayment history and credit, could we have a commitment from the bank that they would be willing to entertain an increased or an independent secondary loan? If I'm making myself
sure. I'm not sure I can provide a guarantee of a future loan agreement, but I certainly we would entertain future agreements.
A guarantee, I think. Sorry if I said guarantee, that'd be a hard thing to hold you to, but just a commitment that if we were to need, say, like this term here, $50,000 in the future, that we have a commitment to work with the bank going forward, basically, that we could, with a good showing on our part and good faith, the bank would be willing to commit to entertaining.
Yeah, we're willing to commit to entering into future loan negotiations. I can't guarantee any sort of financial security in terms of we will or won't provide that loan.
Well, that makes sense, but it's just hard to refuse to go elsewhere, to commit in this loan agreement to refuse to go elsewhere without written consent from the bank. Kind of feels like we're over a barrel in a little bit.
Sure. That has to do with essentially how we retain any deficiencies. So in order to do that, we'd have to go through foreclosure on your equipment and facility. And so any junior lien holders also have a right. So the reason we need prior written approval, typically we do provide that approval. The reason we need it in writing is so that we have the ability to notify them, because it's a statutory requirement that we give notice to all the other junior lien holders if you go into default. Does that make sense? So it's more a notice requirement.
That makes sense. But I guess with that, could we have some kind of understanding that if Pulse was to need a loan in the future of around $50,000 or something like that, that there is some flexibility there with a good showing on the part of Pulse of making timely repayments.
Yeah,
I beforehand. I'm not asking you to guarantee something in the future, which
sure,
is possible.
yeah,
just a commitment to that possibility.
Commitment to future negotiations is no problem.
Okay, thank you. I apologize if I
no, it's fine. It's fine.
Or I misspoke.
Okay, so let's just recap
Absolutely.
One more time. So we're looking at a loan amount of $5 million at an interest rate of 7.25%. Prior written approval from lender with a commitment from the bank that we will entertain future negotiations regarding your lending needs. You'll provide quarterly audited financial records to the lender and indemnify us for any environmental liabilities that result from the contamination of the real estate surrounding the new processing facility. And the loan will be secured through a security interest in Dalco Ltd shares of Dalco Development, as well as a lien on the borrower's equipment and the new facility.
That sounds exact. I'm on the same page throughout that loan as you are.
Great.
Is there anything else lingering that we need to discuss here today before we kind of take these terms back to our clients?
No, I don't think so. It was great working with you. I'm really excited for you guys in your new venture.
Oh, there's one thing I guess we didn't talk about. I apologize.
Oh, no problem.
And I guess we didn't talk about that. The one-time processing fee. Did we just discuss that? If I missed it, I apologize.
Sorry. It's a standard term, so I may have skipped over it. My apologies.
I know my client's gonna ask me about it.
Sure. So typically, on all of our loans, we apply a 2% of the principal loan amount in addition to the interest rate. It can be paid back. It doesn't have to be paid up front, so there's no I understand you guys don't have any capital right now and you have to build it, but it's the 2% of the principal amount is factored into your repayment plan.
Okay, I just want to make sure I was clear on that.
Are you amenable to that?
I, of course, have to talk to my client about that, but
Sure.
I understanding that's a standard term that's built in, they should be okay with that. I would hope.
Okay, great. Nice working with you, Ryan.
Thank you so much.